Every single month you hand over hundreds of dollars for something you hope to never use. Car insurance, home insurance, health insurance, life insurance. You pay and pay and pay, and when you finally need it, they find a reason not to pay in full. Or they pay less than you expected, or they cancel your policy, and your premiums go up anyway. The insurance industry collected over $1 trillion in premiums in the United States alone last year. Have you ever wondered where that money goes? This video explains everything. What is insurance and how does it actually work? Let us start from the very beginning. Insurance is a simple concept. A large group of people all face the same risk. A car accident, a house fire, a serious illness. Most of them will never experience it. But some of them will, and when they do, the cost is enormous. Instead of each person trying to save enough to cover a catastrophe on their own, everyone pays a small regular amount into a shared pool. When someone in the pool experiences the covered event, the pool pays out. This is called risk pooling. And it is genuinely useful. It is one of the most useful financial mechanisms ever created. The problem is not the concept. The problem is what happens between the concept and the reality. The insurance company stands in the middle of the pool. It collects the premiums. It manages the claims. It decides who gets paid. And it keeps the profit. Understanding how the profit is generated and how it is maximized at your expense is what this video is about. How insurance companies actually make money. Insurance companies have two primary income streams that most policyholders never think about. The first is the underwriting profit. This is the difference between the premiums collected and the claims paid out, minus operating costs. In simple terms, they collect more money than they pay out. The entire actuarial science, the mathematics behind insurance pricing, exists for one primary purpose: to ensure the company collects more in premiums than it ever pays in claims. Insurance companies employ enormous teams of mathematicians called actuaries. Their job is to calculate the exact probability of every possible event and price premiums so that expected claims are always less than expected premium income. They are very good at this. The second income stream is investment income. Here's the part most people never think about. When you pay your premium, that money does not sit in a drawer waiting to pay your claim. It gets invested immediately. The insurance company takes your premiums and everyone else's premiums and invests them in stocks, bonds, and real estate. The time between collecting premiums and paying claims is called the float, and the float can be invested for months or years before a claim is paid. This investment income is enormous. Warren Buffett built Berkshire Hathaway into one of the most valuable companies in history, primarily by using insurance float as an investment fund. You are essentially giving the insurance company an interest-free loan that they invest at significant returns while you wait and hope you never need to claim. Why your premiums keep going up. If you have noticed your insurance premiums rising dramatically in recent years, you are not imagining it. Car insurance premiums in the United States rose by an average of 26% in 2023 and 2024, the largest two-year increase in recorded history. Home insurance premiums in Florida, California, and Texas have risen so dramatically that major insurers have simply stopped offering coverage entirely in some areas. In the United Kingdom, car insurance premiums hit record levels in 2024 and have continued rising through 2026. In Canada, home insurance premiums have risen over 30% in some provinces in the last 3 years. There are legitimate reasons for some of these increases. Climate change is making extreme weather events more frequent and more expensive. Inflation has increased the cost of replacing cars, rebuilding homes, and paying medical bills. Supply chain disruptions increased repair costs dramatically. But there are also business reasons. Insurance companies are businesses. They have shareholders. Those shareholders expect profits. When underwriting profits are squeezed, companies raise premiums. When investment returns are lower, companies raise premiums. When a competitor raises premiums, other companies use that as cover to raise theirs too. And here's the critical thing most people do not understand. Loyalty does not pay in insurance. In fact, it costs you. Insurance companies routinely offer their best prices to new customers to attract them, then gradually raise premiums on existing customers year after year. This is called price walking. It was partially restricted in the UK in 2022. But it still exists in various forms everywhere. The claims game. Why it is harder than you think. You paid your premiums faithfully for years. Something goes wrong. You file a claim. Surely this is straightforward. It is not. Insurance companies are experts at claims management, which is a polite phrase for minimizing how much they pay out. The first tool is the policy exclusion. Every insurance policy contains exclusions, events and circumstances that are not covered. These exclusions are written in dense legal language in documents most people never read. The exclusion only becomes visible at the moment you need to claim. Flood damage is typically excluded from standard home insurance, requiring a separate policy. Water damage from a burst pipe is covered. Water damage from a flood is not. The distinction matters enormously when your basement is underwater. The second tool is the claim investigation. Every claim above a certain value triggers an investigation. The investigation is designed to find reasons to reduce or deny the claim. Prior existing conditions, contributing negligence, incorrect information on the original application, failure to maintain the insured property appropriately. In the United States, insurance companies denied approximately 17% of all claims across all categories in recent years. Some categories are far higher. The third tool is the settlement offer. When a claim is approved, the first settlement offer is rarely the full amount. Insurance companies know that most people will accept a lower offer rather than fight. The cost of fighting on time, stress, legal fees makes many people settle for less than they are entitled to. Understanding this before you claim and being prepared to push back is essential. Car insurance, the numbers behind what you pay. Car insurance is the most universal form of insurance. In almost every state and country, and it is legally required to drive. This mandatory nature gives insurance companies an extraordinary advantage. You have no choice but to buy. The only question is from whom? The average American pays approximately $2,000 per year for car insurance. The average British driver pays approximately £1,200 per year. The average Canadian pays approximately $1,800 Canadian dollars per year. What determines your premium has little to do with your individual driving history and much to do with statistical risk categories. Your age, your gender in many jurisdictions, your zip code or postal code, the type of car you drive. Your credit score. Yes, in most U.S. states, your credit score affects your car insurance premium. Your occupation in some cases. The algorithm that prices your premium is designed to extract the maximum amount you will pay before shopping elsewhere. This is why comparison shopping at renewal time, every single year without exception, is one of the most reliable ways to reduce your insurance costs. Switching insurers at renewal is estimated to save the average American household approximately $400 to $700 per year. The loyalty penalty is real and it is significant. Health insurance in America. Why it works the way it does. The United States spends more per person on healthcare than any other country in the world. And yet, it has worse health outcomes on most major metrics than peer nations like Canada, the United Kingdom, and Western Europe, most of which provide universal health care through government systems. The reason is the private health insurance model. In the American system, health insurance companies sit between you and your health care. You pay premiums. Your employer may contribute. The government funds some through Medicare and Medicaid. The insurer decides what is covered. What requires prior authorization. Which doctors and hospitals are in network. What your deductible is. What your out-of-pocket maximum is. The average American with employer-sponsored insurance pays approximately $1,800 per year in premiums, with their employer paying an additional $7,000 plus. The total annual premium for a family plan averages over $23,000. This is before deductibles, copays, and out-of-pocket expenses. Medical debt is the leading cause of personal bankruptcy in the United States. This does not happen in countries with universal public health care. The health insurance industry spends over $500 million per year lobbying Congress, largely to maintain the system that generates its profits. Understanding this is not a political opinion. It is the documented financial reality of how the system is structured and who it serves. Home insurance, the crisis nobody is talking about. There is an emerging home insurance crisis in the United States, United Kingdom, and Canada that will affect millions of homeowners in the next decade. In Florida, 8 major insurance companies have left the state since 2022. The remaining insurers have raised premiums so dramatically that the average Florida homeowner now pays over $6,000 per year. In California, State Farm, Allstate, and other major insurers have stopped writing new home insurance policies entirely. In some high-risk areas, insurance is simply unavailable at any price. In the UK, homes in flood risk areas are increasingly uninsurable through standard policies. The government-backed Flood Re scheme provides some coverage, but it is temporary and limited. In Canada, wildfire risk is making home insurance unaffordable or unavailable in parts of Alberta and British Columbia. The mechanism driving this crisis is climate change. Insurance is fundamentally a prediction business. You can only profitably insure risks you can accurately price. When the frequency and severity of catastrophic weather events increases beyond what historical models predicted, the insurance pricing model breaks down. Insurers have three options: raise premiums dramatically, reduce coverage, or exit the market. In the highest risk areas, all three are happening simultaneously. A home that cannot be insured cannot be mortgaged. A home that cannot be mortgaged cannot be sold. The insurance crisis is the beginning of a property value crisis in the highest risk areas, and it is already underway. How to beat the insurance industry at its own game. You cannot opt out of insurance. In most cases, you need it and you are legally required to have it. But you can dramatically reduce what you pay and dramatically increase what you receive when you claim. Rule 1. Shop every single year at renewal. Never auto-renew without comparing. Insurance companies count on inertia. The comparison takes 30 minutes. The saving can be $400 to $700. Rule 2. Increase your deductible for lower premiums. A higher deductible means you pay more out of pocket before insurance kicks in, but it dramatically reduces your annual premium. The math usually favors a higher deductible if you have emergency savings to cover it. Rule 3. Bundle policies with the same provider. Home and auto bundled with the same insurer typically saves 15 to 25%. The discount is real. Rule 4. Know what is excluded before you need it. Read your exclusions. This is deeply boring. It is also the difference between a paid claim and a denied one. 30 minutes reading the exclusion section saves thousands when something goes wrong. Rule 5. Do not make small claims. Every claim goes on your record and can raise your premium at renewal. For smaller amounts, below or near your deductible, it often costs less to pay out of pocket and protect your claim's history. Rule 6. Document everything. When you need to claim, documentation is power. Photographs of your property, vehicle, and valuables. Receipts for major purchases. Service records for your car. The more documentation you have, the harder it is to deny your claim. Rule 7. Push back on low settlement offers. The first offer is rarely the best offer. Get independent assessments. Reference comparable claims. Know your policy entitlements. Insurers negotiate must, especially when you are informed and persistent. Insurance companies are running a profitable business using your money. Understanding how that business works puts you in a significantly stronger position on both sides of the transaction. Let us bring everything together. Insurance is risk pooling, a genuinely useful concept that protects individuals from catastrophic costs. Insurance companies make money through two streams: underwriting profit and investment income from your premium float. Premiums are rising at historic rates due to climate change, inflation, and business incentives, and loyalty costs you more than switching. Claims management is designed to minimize payouts through exclusions, investigations, and low initial settlement offers. Car insurance is mandatory and heavily algorithmically priced. Shopping at renewal every year is the single most effective way to reduce costs. The American health insurance system is structured to generate profit rather than health outcomes, and the costs reflect that priority. The home insurance crisis in high-risk areas is already creating a property value crisis in those regions. Your best moves are annual comparison shopping, higher deductibles with emergency savings, bundling, understanding exclusions, protecting your claims history, documenting everything, and pushing back on low offers. You cannot beat the system entirely, but you can play it significantly better than most people do. This is not financial advice. Please consult a qualified financial and insurance professional before making any coverage decisions. Check out other Broke Monkey videos for more financial topics explained simply and clearly. If you want to support this channel so we can keep making these videos, check out the link below. Apes together strong.